Welcome back, accounting superstars. Thank you for joining me today to discuss the common errors for accounting for accounts receivable, notes receivable, and accounting for revenue. So down here below, I have some common errors that we can talk about, but we'll just pull up an example question. Okay, so this first question on the assignment 2, we are dealing with accounting for recognizing revenue from long-term contracts. And this question was done quite well. Some of the deficiencies, let's look at them here side by side, included not having the correct gross profit for all years. So ensure that you're following the proper format as guided in the textbook. You should get the percentage complete, which was 30%, 65, and 100 respectively. And then from there, you would calculate your revenue to date and subtract your construction costs to get your gross profit. So try recalculating your gross profit for all years if you believe there is an error there. Now, another error in this question had to do with journal entries. If we are doing simple journal entries, which just involve 2 accounts, then we would have had 5 journal entries, 1 to record the cost of construction, 1 to record progress billings, which we of course had to calculate. Some people use the progress billings of this 2175, but however, we needed to subtract this progress billings from the prior year, so that was a common error there. The third journal entry, we needed to record the collections on the accounts receivable, and the fourth, recording the revenue. That was done quite well. And that, of course, would have to match the revenue that you had calculated in the first part of the question when you're doing the contract price schedule with the percentage complete and you're calculating the revenue to date and the revenue for the current year, etc. Okay, and then the last journal entry for this part 2 would then be the construction expense, and that journal entry amount would actually match the first journal entry of recording the cost of construction, just for the amount, not for the journal entry accounts. Okay, and then another common deficiency was the gross profit using the completed contract method, which actually was requirement 3. That was missing on a few papers. But generally a very well done question overall. Let's move on. In question 2, we are testing LO5, performing accounting to recognize revenue from the sales of goods and services. Okay, so now the major deficiency here would be this one, that we are to use the fair value amounts to calculate the allocation and not the cost amount. So I believe everyone was able to come up with an allocation chart. Now, when you're doing your allocation chart, you need to have the fair value, and that fair value for this elevator should actually be the contract price of this 250. And now that makes complete sense that the contract price would be the fair value amount because that is the current selling price. So that would be the fair value. Many people put 150 as the fair value for the elevator, and then their total would have been the 155, so the 150 plus that 5,000 for the installation. But of course, we now know that we need to use the contract price of that 250 for that elevator fair value, because this is, of course, the cost to Humphrey, But the fair value is actually what we need in that fair value allocation chart. And so then the allocation should work out to be 98.04%. And then after that, the journal entries, the main deficiency here would be, well, the journal entries as a whole, actually students did struggle with. So I would just recommend that this question be referred back to a similar question in the text. Basically, there were 4 different journal entries that we needed to record. Well, 3 different dates. We had one on April 2nd to record the customer down payment. That one was done quite well. However, we needed to credit unearned revenue. So that was something to note. And then we had on April 15th, we needed to record that revenue, but we also needed to record the cost of goods sold. And May 31st, then we had to record that installation service and then the cash received from the customer. So go ahead and review that question if you struggled with that there. Okay, we will move along here. Now on the third question, we are looking at performing accounting for AR. This question was very well done generally. Now the only thing to note here is sometimes that bad debt expense was miscalculated. So ensure that you're accounting for the balance that you want to record in allowance for doubtful accounts and account for what is the beginning balance. And then from there, you would calculate the adjustment. Okay. Question 4 is dealing with notes receivable. One thing to note here is that when we're recording that initial journal entry, we need to record that at the present value amount and not the future value of that 510. So our first step was to convert this base value into our present value, and then from there we needed to record that present value for the journal entry. Okay, the journal entries for the interest revenue was fairly well done. Now for the interest, ensure that we're using that present value that we recorded in that first journal entry. We're multiplying that by the interest rate at which Mango would typically arrange financing. So we're using that 12%. And then from there, for each interest entry for 2023, for instance, now we're just increasing the value of the note receivable by that amount that we calculated in that prior entry. And then we're now multiplying that new carrying value of the note receivable by that market rate of 12%. Okay, so that question was fairly well done. The biggest thing was just calculating the present value and recording it at the present value, and then of course effectively using that effective interest rate method. Okay. Okay, question 5. Whoops. Question 5 was also fairly well done. The only thing to note here that the last journal entry, sometimes that one was recorded incorrectly. Let's just take a peek at the other mentions here. July 31st entry, take note that we debit that interest receivable and not the note receivable. So when it has to deal with amortizing the discount or premium, that is when we're actually debiting or crediting the note receivable. But if it is just interest, then we actually would debit that interest receivable and not that note receivable. Okay. We'll move on here. That one was generally well done, but like I said, if you had trouble with that one, I would refer back to the last journal entry and take note that we would have to credit the interest receivable from that prior July 31st entry, and then also we would have another interest revenue amount to credit as well. Okay, now number 7 was actually super well done. Oh, did we skip over 6? Okay, 6 was very well done as well. Most people were able to correctly calculate the present value of the note. Now, if you did have trouble with that, most people, I will let you know this, that it's not in the 300,000s. That's not the present value. That is the present value of the note, but then we also need to calculate that present value of the interest payments. So remember that when we have interest payments, we need to do 2 calculations for the present value. We need to calculate the present value of the note receivable, and then also the present value of the annuity, which is those annual or semi-annual interest payments. So that was something to note there for number 6. So you may have had incorrect journal entries. You may need to redo that amortization table, etc. So you can read through those. And the last question pertaining to accounting for accounts receivable was very well done. The only thing to note was to ensure that the recourse liability is recorded there, and ensure that it's recorded on Tulip's side, but not on Marathon's there. Okay, and that concludes it for assignment 2.